All right, let's talk about the stock market. It's been on an absolute tear lately, but when you look under the hood, the story gets a whole lot more interesting. So today, we're going to break down a really crucial question for every investor. As this tech rally gets more and more extreme, where are the hidden risks, and more importantly, where are the new opportunities?
So, if you just glance at the market, things look pretty amazing, right? The S&P 500 has kept its summer rally going and is up over 10% for the year so far. I mean, that's a fantastic return by any standard. But, and this is a big but, the real story is what's actually driving that number.
Yeah, this isn't some case of a rising tide lifts all boats. Not at all. This incredible performance is basically being powered by a tiny handful of tech giants. And that intense concentration, well, that's what we're digging into today. All right, so let's really get into this. Because, underneath that nice shiny 10% gain, there are some pretty big risks starting to build up. The market is way, way narrower than it looks.
Get this. The tech sector now makes up a record 34.5% of the entire S&P 500. And just to give you some perspective on that, back in 2018, it was only 20%. I mean, that is a massive jump in just a few years.
But you know what? That number, as big as it is, doesn't even tell the whole story. It actually understates the problem. See, the way the index is set up, giants like Meta, Alphabet, and Amazon aren't technically in the tech sector. It's crazy, right? So if you add them back in where they really belong, the actual tech weighting is something closer to 45%.
And the size of these individual companies, it's just mind-blowing. Take a look at Nvidia. Its market cap is now $4.4 trillion. That's so big, it's almost the same size as the entire healthcare sector. Just let that sink in for a second. One company versus every single drug maker, every insurer, all the hospitals, all of them combined. It's just, wow.
So that naturally brings us to valuation risk. I mean, what are people actually paying for these stocks? Well, Nvidia is trading at 20 times its projected sales, not profits, sales. Now compare that to other sectors like healthcare and energy. They're trading at a much more reasonable 15 times their actual earnings. And that huge gap between paying for sales versus paying for profits, that's historically a pretty big red flag.
And it's not just about the price tags. There's a fundamental shift happening in the business itself. For years, the whole sales pitch for tech was that it was capital light. They didn't need a lot of heavy equipment, so the profit margins were huge. Well, this quote from Cole Smee just nails it. That whole idea is kind of going out the window.
I mean, to power this whole AI boom, these companies have to spend an insane amount of money on data centers and infrastructure. We're talking about Alphabet spending maybe $85 billion this year, and Meta is not that far behind. So here's the bottom line. Their capital spending, as a piece of their total revenue, has basically doubled over the last 10 years. And that puts some serious pressure on their free cash flow.
This whole situation kind of reminds me of a classic cautionary tale, Kodak. Here was a company that absolutely dominated the 20th century. They were hitting peak profits as recently as the year 2000. But then they got completely wiped out by the digital camera. And here's the crazy part. It was a technology they actually helped invent. It's just a perfect reminder that no matter how big you are, no one is safe forever.
Okay, so let's recap. On one hand, you have these incredible gains, all fueled by big tech. But on the other hand, you've got these growing risks, concentration, insane valuations, and changing business models. So that leads us to the billion-dollar question, right? If you're an investor and you want to protect yourself, where do you even begin to look?
All right, so let's do exactly that. Let's go exploring and look at some of the other parts of the market, the ones that maybe aren't getting all the love right now that some analysts think could be real opportunities. First up, let's talk about healthcare. And this quote really says it all. When you compare healthcare stocks to the rest of the market, they are cheaper right now than they've been in 30 years. 30! That's a really long time.
And the argument for it is pretty compelling. For starters, the whole sector is actually down this year, which means valuations look pretty good. You've got these solid giants like United Health, which by the way is a new Berkshire Hathaway pick, trading at a low multiple. And at the same time, you have huge innovators like Eli Lilly, which is just crushing it in the massive weight loss drug market. Okay, let's move on to another one. A sector that a lot of people have basically written off. Energy. But listen to this. Some analysts are making a really bold call here, saying this might be one of the best times to buy into energy in a decade.
So what's the argument? Well, first, the sector's been flat this year, so a lot of the bad news is probably already baked into the price. Here's a big one. That AI revolution we keep talking about, it needs a staggering amount of electricity, and that's where conventional energy comes in. Plus, the whole sector is trading at a cheap 15 times forward earnings, and it can be a really good hedge if inflation sticks around.
Okay, before we go further, let's talk about a strategy for investors who are looking for income. We need to quickly define a term you hear a lot: dividend aristocrat. So what is it? It's basically an elite club. These are companies in the S&P 500 that haven't just paid a dividend, they've increased it every single year for at least 25 years in a row. It's a huge signal of financial health.
So, a smart income strategy isn't just about finding the highest possible dividend yield. That can actually be a trap. The real secret is to look for these aristocrats that are also cranking out tons of free cash flow. When you have both of those things, you know they've got the money to keep that streak of dividend growth alive.
And last but not least, let's touch on a classic defensive move: gold. A really straightforward way to play this is through a company like Newmont, which is the biggest gold miner in the world. And the stock actually looks pretty cheap right now, with a PE of just 13. On top of that, they're generating record amounts of cash and are using it to pay down their debt, which is always a good sign.
Okay, so we've looked at the big risks in tech, and we've explored some interesting alternatives. So, what's the big picture here? What's the one thing you should really walk away with?
Well, the key insight is pretty clear, right? Tech has given us some absolutely amazing gains. There's no denying that. But that same success has created a market that's so concentrated in just a handful of stocks that the risks are becoming pretty obvious. From crazy valuations to the fact that their businesses are getting more expensive to run.
Now, the point of all this isn't to say sell all your tech or try to time the market perfectly. It's much simpler than that. The big takeaway is that maybe it's time to get back to basics, to that old school idea of diversification. Looking at some of these forgotten sectors like healthcare and energy, or thinking about defensive plays, might just be a really smart way to make sure your portfolio is ready for whatever the market throws at us next.
And that really leaves us with one final big question to chew on. We saw what happened to Kodak, a reminder that no company, no matter how dominant, stays on top forever. So, in a market like today's where a few tech giants look completely unbeatable, maybe the single biggest risk you can take is betting that this time is different and that they'll rule forever?